Sorry, what's the question? The report that you've done with us, we've now done two, and they both show that alpha is real in this market.
Yes, we started in 1987. We were the first credit rating agency to be set up in the country.
CRISIL is in a unique position to get information on the whole market. So just how have you seen the evolution of the AIF market?
When we started putting out benchmarks, we were putting out benchmarks on the broader three categories of AIFs, and today we have about 15 subcategories.
I mean, if the Indian market continues to grow at the pace it has, it will reach the size of the Chinese market within 10 years. Yeah. What is CRISIL and how long have you been with CRISIL?
Yeah, so David, I've been with CRISIL for about 20 years now. Yeah. And CRISIL, in fact, started off as a credit rating agency. We started in 1987. We were the first credit rating agency to be set up in the country. And over a period of time, we have grown. And we have grown in terms of the nature of coverage that we have. The business that I represent, is one of the premier businesses, from a Indian financial markets perspective. We put out views on the economy, on sectors, companies, capital markets, investment products, and private markets, that we are going to be speaking about today is an area, where we have, we have ventured into recently. 2020 is when we started putting out benchmarks on alternate investment funds, and that's an area of interest for us.
Oister started about 2.5, 3 years ago, and its role in the market here is to really help investors gain access, identify and gain access to the top half, the more successful funds. The risk in the Indian market that we've seen is that unlike, it's a bit opposite to the US market. The Indian market investors have been active in the funds, but now the better funds are getting onto Fund 3, Fund 4, and they've got access now to institutional capital, and they're beginning to raise their minimums and start to shut out. So Oister's role is really to maintain that access and increase it, but also by surveying the market and identifying which GPs have got a pretty good probability of staying in the top half of performance, give people much more curated access to the market than they've had previously.
That's very interesting, David. In fact, the kind of analysis that we do within CRISIL around alternate investment funds, there are some things, that really stand out. One is that, while the category per se has outperformed, we also see differences in terms of, performance between the top quartile and the bottom quartile players. And second, we also see that, this is a space where there is the need for a lot more understanding of investment processes. There are different types of players who are present. A lot more understanding is needed around processes, around governance, around the practices that are being followed. And in that context, the role that Oister may possibly play in terms of, evaluating funds, is going to be really useful for the end investors.
Yeah, thank you. I think as the market evolves and grows and they become more and more managers, it's going to be more and more necessary to have some sort of professional group assessing the market and analyze it. The scope just gets too big.
That's right.
In the context of the US market, virtually no individual investor would try and go it alone. The market's just got to the scale where it's too large. And India will be heading in that direction.
Yes.
If the Indian market continues to grow at the pace it has, it will reach the size of the Chinese market within 10 years.
Yes.
So it really is growing very fast. I think one of the advantages, and this sort of speaks to CRISIL's role, that the Indian market has is that the regulator, SEBI, because it's come from a public markets background, expects transparency.
That's right.
And you look at the private markets in Europe and America where they've started, they're far from transparent.
Yes.
But SEBI's required the reporting to provide the indices.
Yes.
And you're one of those people who get the data, and CRISIL's one of the groups that gets the data and provides the index. That ability to have a publicly available index is huge.
Yes.
Because if I try and analyze the US or European markets, I've got a choice of, 4 or so different index providers, all of whom have different information.
Yeah.
And it's sort of hard to reconcile indices. India is going to be the one market in the world where there is one index, and it's going to be consistent, so you can see what's going on.
Yeah.
And in that context, the fact that the latest report we've done together, and also the previous one, showed that this market is creating alpha on a fairly consistent basis. Right. The last one, what was it, 5.6%? I forget.
Yes.
The alpha of the market.
Yes.
One, it's a standard number, which it's difficult to get, but also it really shows that this market has arrived. I mean, you've been calculating the alpha over 6-month intervals,
Yes,
and it's never gone negative.
that's right.
So it really does demonstrate a depth and maturity of market
That's right.
that now makes it much easier for asset allocators to apply portfolio theory to this market, as has been possible in the US for decades.
Yes. In fact, I mean, just to add, we are in India now seeing a lot more investor segments, warming up to, investing into private markets. So you have family offices, you have, some of the domestic institutional investors, who are interested as well. And in a lot of cases, the kind of experience, expertise that is needed, may actually have to be taken from outside, for really selecting the funds, when they are actually planning their investments. And in that context as well, the role that Oister can possibly play will be important.
The more you try and get investors exposure to the market,
Yes.
the more they really do need an experienced intermediary to guide them. Having said that, some of the Indian investors in the family offices I've met are very sophisticated.
Yes.
So it's not as though this is in an unsophisticated market.
Yes.
But nonetheless, if you're reaching into the large group of investors who are new to the market,
That's right.
they're definitely going to need some help.
Yes.
Just on the point of, I think you just mentioned China before. The India compared to China, I mentioned that I think in 10 years' time India will get to China's size. I also think it's probably on at this stage, a more predictable trajectory.
Yeah.
I mean, the Chinese market took off very fast about 20 years ago.
Yeah.
But you can now see people shifting
Yes.
as the policy environment there has become less market friendly.
Yes.
These are long-term investments. And so you need some sort of policy
Continuity.
certainty for a 5-year period, a 10-year period,
Right.
which unfortunately now you don't really have in China
Yes.
from a foreign investor's point of
Yes.
view. And so we're beginning to see that shift in reallocation.
Yes.
And that's shown up most clearly. We had some numbers from the Global Private Equity Association, Global Private Capital Association, sorry, which show that at the larger end of the market in private equity, for the first time in a long time, allocations to India by large foreign investors far outstripped China. That was just in the first half of 24.
Yeah.
And normally it's been running, I think I'm going to get the figures right, the Indian allocation to India compared to China has been about 17%.
Yeah.
Now it's over 120.
Yeah, that's right.
So it's quite a turnaround, and I think that just shows the rising confidence people have in this market.
That's right. And in terms, I mean, since you have a very good understanding of the global markets as well, in terms of actual performance, how would you compare India with the rest of the world?
Well, the rest of the world, there isn't growth. It's one of those sad things. Good for India, but sad for everyone else. That if you go back to 2012 or so, just after the financial crisis, the Indian market wasn't really present.
Yes.
It didn't exist. But you did have private equity, not so much venture capital, but private equity in a lot of emerging markets. Brazil, Russia, Turkey, Africa. In fact, back then KKR set up an African fund to invest. All that's withered on the vine.
Yeah.
Because the growth in those countries just hasn't held up.
Yeah.
Whereas India, with the policies that have been put in place since about 2010, really encourage not just macro growth, but also stimulate the VC end of the market.
Yes.
There's over 151,000 startups registered, and that's growing at 30% compound or 33% compound.
Right.
So there really is a lot of policy conditions that have gone on here, which are making the Indian market the standout.
Yes.
So really, the only comparison had been China, but now the change in environment there, that's off. So then the only comparison left is the US.
Yes.
And not to insult Europe, but it's the US. And the difference really is one of scale. I mean, there's different numbers out there, so it's hard to get an accurate reading on what the scale difference is. But the US market is huge multiples bigger than the Indian one. But nonetheless, the Indian one has got to a scale where it really is investable. It's got to a stage of maturity where you've now got over 60 GPs on investing their third fund or more.
Yes.
So there's all that experience sitting there. it's not as though it's sort of, it's not the Wild West at all.
Yeah.
You've got a very good regulator increasing transparency. So in fact, I think over time the Indian market will be more transparent than the US market, which I think US investors will find hard to believe, but I think it's going to be the case. So really the difference is scale.
I mean, you spoke about maturity. I think, even in terms of the commitments, that are being raised by, the people who have launched funds earlier, they have only been seeing increasing commitments, being raised. So, which is again, which shows conviction in terms of, the investors, in terms of their, their GPs, from the perspective of investment.
What trends are you seeing in terms of the type of investors who are in the market? Individuals, institutions?
So we, in fact, we of course see individuals, family offices, etc., having a far more deeper conviction around investing into private markets. The big space, which is kind of the latent space, from an India perspective, is really the domestic institutional capital, the likes of an EPFO. I mean, a lot of the retirement assets, for that matter, EPFO, PFRDA as well, the pension regulator. Not much is actually being invested today, and they are actually looking at alternates, as a category, when it comes to investing. So they're evaluating that. Now that, if that happens, that's like a large cash flow, that can actually come into the private markets. The other piece, of course, is some of the government budgetary allocations, that have also spurred growth in terms of alternates. For instance, SIDBI manages a fund, that has been raised by way of a budgetary allocation towards investing into startups, and that's a fairly large sized fund. Insurance is the other sector, where again, there is interest. Some of the insurance companies have actually started investing into alternates, but it's still much lesser than what is permissible for them as per the pattern of investments from IRDA. So while there is interest on the individuals, the family offices side, and they may possibly be the ones who will be putting a larger amount of monies into alternates. The second would of course be the government allocations. The larger pool is really the insurance and the retirements, which is kind of warming up to the idea today.
Of the different metrics that people report, so you've got IRR, TVPI, DPO, all these things. How would you view those different ones? I mean, I've got my view, but what's...
Yeah, so...
You can ask me back, but...
I will. So, I think there are two core things. One is, of course, the IRR, which would reflect the consolidated performance, that the fund manager has been able to generate in terms of the, the monies that he has raised, which is an important metric, that shows what is really the total return. The other metric, which is equally important, is really the DPI, or the actual payout, that has been made to the investor. And the two, of course, represent two parts. One is the total return, and second is really the actual realized return. There has been a lot of discussion, debate around valuations, and whether exits can really happen at the kind of valuations that are being used for calculating the NAVs. So therefore, the DPI becomes a very important number as well, which effectively means how much is the return that has been paid out to the investor in the AIF. And the report that we published along with Oister, that clearly shows that one, the total return of the IRR is very, very good when you compare it with the public market equivalents. The DPI is also pretty good, and and it's really, really nice for the funds from the top quartile. So the two numbers actually, according to me, need to be looked together. I'll be happy to have your views.
Yeah, no, I'd agree. I think it's a balancing act.
Yeah.
Because obviously at the end of the day, you need DPI.
Yeah.
And when DPI isn't coming, investors are right to sort of question, well, why isn't this coming? Although having said that, there are funds with very good DPIs. So I think it's India Quotient, so their early fund is on a bit over 7x. Bloom's early funds are on about 4.6x. So there are some good numbers there. But when they're lagging, people are right to question. However, the issue is if you exit, then you absolutely terminate the IRR and the TVPI. And if you talk to some very large institutional investors overseas, they really want the long-term compounding effect. So in their minds, as long as the companies are growing at a good pace, as long as the growth is there to eventually support valuations, they'd rather have the compounding. So they're focused more on the TVPI than they are on the DPI and the IRR to some extent. On the other hand, if you've got surges in valuations, so valuations are sort of running fast, and possibly running ahead of the growth of the companies, then you might as well cash out and and lock it in and get the DPI. So I think it's a situation of intelligent trade-offs. The report that you've done with us, we've now done two, and they both show that alpha is real in this market. I think the last one showed for the aggregate a bit over 5, and also very close to 5 when you split it between smaller cap and larger cap. So it's across the market, it's not just in one place. But how does that get calculated? What is PMI? I mean, how real is this?
So that's the public market equivalent. And the way we calculate the PME is, we replicate the cash flows, that we see in case of the funds. We replicate them in terms of investing into the public market equivalent. So, we spoke about the Sensex, the BSE 200 and the small cap indices. Whatever are the cash flows, that are hitting the funds when we are calculating the return for the funds, we replicate that in the index as well. So effectively, it is a very, very like-to-like comparison in terms of cash flows that are either getting deployed into the private market funds or into the public market funds. So it's a very like-to-like comparable.
And this is something that's internationally accepted?
Yes, that's right. That's right. So that there is no timing mismatch that happens in terms of your benchmark.
I think so. Certainly, I mean the numbers that are coming out are quite healthy. I mean the latest one was a bit over 5 in the aggregate, but it's been fluctuating up to 20. But never gone negative, at least in the period that we've been looking at. So it does seem pretty healthy and pretty solid.
Yes, it does. Now, of course, we see. So one is of course the performance. Then when you look at conventional performance analysis, the other elements that you look at is is diversification. Is it skewed towards a specific sector and so on. So now at least from the private market deployment perspective, we are now seeing a lot more allocation towards newer sectors. Like agri-tech, for instance. We see some interest in sustainability as well, green financing. Fintech is another sector. Earlier we had a significant skew towards consumer-driven technology, as a sector. But now we are seeing that diversification, or for that matter, broadening of opportunities, that are there. And second, we also see allocation to cities beyond tier 1. So from a geography perspective as well, now we see a larger allocation towards cities that are beyond tier 1.
So the whole opportunity really is broadening out.
That's right.
Both in terms of sectors, themes, and geography.
That is right.
Which is another indicator of a market that really is evolving and maturing.
Exactly.
I mean, the other thing that was interesting in the report was that the increase in large-scale transactions. And from memory, they'd gone from about 10 years ago, 10% to now 28%?
That's right.
Because that really opens up the opportunity to the large international investors, whose minimum check size can be quite large. And the more you do that, the more, as soon as you get to a size of deal that enables that pool of money to come in, you really start to open a very powerful exit window, which the whole market benefits from.
And globally, co-investing is a theme as well. So how do you see that? If you were to look at India?
I've got a particular view on co-investments. All the funds here do offer them, and it's an attractive thing for investors, but you've got to be careful. I mean, the original enthusiasm for co-investments from US institutions was as a way of cost averaging the cost of investment, because the fees on co-investments were much lower than the fees on the fund. Right. And theoretically, they should return the same amount of money. So you get more money deployed at a lower cost. Yes. And that was what was exciting to institutions. However, you have to be careful about concentration, because there has been, and careful which co-investments you select, because there has been some research, I think it was by Cambridge Associates some time ago, that showed that on average the co-investments that big institutions had done were possibly not as exciting as they'd thought. Sure. And it was simply that there tended to be a selection bias. The companies that were made available for co-investment, certainly in the bigger funds, and this is private equity, not venture capital I'm talking here, but tended to be the deals that were too big for the fund, or the deals that came late in the fund, so the fund was getting low on cash and needed the extra money. Those are perfectly neutral selection criteria, but they're not positive selection criteria. And so there's an issue there.
Understand.
But I think then again, if you look at secondaries, a lot of people are very wary of secondaries because they suspect that, the GP can't sell the company, so why am I buying this guy's thing he can't sell? And there is an element of truth to that. You do have to watch the reason for what's going on. But there's some analysis, where did that come from? I think it was from Hamilton Lane, that showed the risk-return profile of secondaries was more attractive than co-investments, because the secondaries were more mature investments. They'd been running for longer. They weren't a black box. You could see what was going on. And so if you liked the company, it's perfectly logical to invest. Yes. And a lot of the secondaries quite often come from earlier stage funds, where their real core focus, their core strategy, is seed or A or something like this, those rounds. But they've now got a lot of insight into the company as it grows and goes further. It's not their core of expertise anymore, but nonetheless they know the company, and they've got the rights to follow it. So you can benefit from their knowledge of the company. You can benefit from their rights and get access to something that is much more accessible and analyzable than a co-investment. CRISIL is in a unique position to get information on the whole market. So just how have you seen the evolution of the AIF market?
Sure. So it's a market which has grown quite rapidly over the past few years. It's about 12 trillion in terms of commitments raised, a little about 12 trillion in terms of commitments raised, about 4.5 trillion, in excess of 4.5 trillion, that's actually been deployed. We also now see a wider array of investment themes, as well as types of investment managers, who are putting out funds on the AIF side. So you have private equity, you have VC. Even within VC, private equity, we spoke about some of the sectoral breakups, that are there. There are funds, which are very, very thematic, that are getting launched. We see a lot of interest in debt in the recent past. Again, within debt, there are different categories, that are getting launched. Just to give you a perspective, when we started putting out benchmarks, we were putting out benchmarks on the broader 3 categories of AIFs, which are required by SEBI. And today we have about 15 subcategories. And there's clearly an ask from the industry that 15 may not be enough, because of the diverse themes, that exist in the industry today. Second, in terms of the parentage, the nature of AIFs who are present in the market, there are people with global parentage. There are LLP structures, which are largely being run by a set of individuals. There are institutional funds as well, that have come up, which are largely run by entities, which have a presence in the financial market space. So there's a wide array of fund managers as well, who are present in the country today. And last but not the least, I think, it's also a space, where we see a lot of regulatory changes, which have benefited. So it was when it started, it was a segment, where there wasn't really too much of regulatory guidelines. Now we see a lot of guidelines as well, that have come into play, a lot more focus, and it's obvious, because the size and scale of the industry has also grown over a period of time. And last is, of course, the investor segmentation. So we have, and I think we spoke about this earlier. So earlier it was largely the global investors who are deploying monies into the AIFs. Today we see a lot more interest on the domestic side as well. You have HNIs, you have family offices, you have some other domestic institutional investors, and some more segments who are now looking at putting monies into the AIFs. So it's an industry which has really grown quite exponentially over a period of time.
Growth really has been quite extraordinary.
Yes.
Because if you look back, as I said earlier, to about 2012, there really wasn't an investable industry.
That's right.
But with the globalization of venture capital, with digital tech,
yes.
And India was standing right in the path to be the biggest beneficiary of that.
Yes.
I think India has the second largest number of programmers after China.
Yes.
I think China's something like 7 million, or software developers. India's
yes.
4.8 million.
Yes.
5.8 million. And it's the US that's down at 4 point something. So it's in between China and the US. So in terms of the shift of venture capital to a digital base rather than
yes.
deep tech,
yes.
India's just been right in the path and a big beneficiary.
Yes.
And it's interesting, the linkages you can see between the industry here and Silicon Valley. So I think it's something like 6% of employees in Silicon Valley are of Indian origin.
Yeah.
25% of founders of startups in Silicon Valley are of Indian origin.
Yeah.
And then there's, I think, something like 58 major corporations that have Indian origin CEOs. So you're from Microsoft, Alphabet,
yes. Yes.
IBM. And these linkages are really quite apparent.
Yes.
When you talk to the venture capital community here, they all know what's going on in Silicon Valley and vice versa. So it's not as though the industry here has been sort of growing in some sort of isolation.
Yeah.
It's been helped by government policies,
yes.
but it's also been helped by just a very strong linkage with I guess, what you might refer to as the mothership of VC.
True. True. One question I had was, our report, it clearly shows that there's consistent alpha, that's being generated year on year, by the AIFs. And you see that, also, if you were to look at it in terms of the different categories of funds, whether it be the early stage funds or the late stage funds, vis-a-vis relevant benchmarks. So as an allocator, how do you see this, and what does it mean for investors? What are the things that they need to be looking at, and what would you also look at, when you are deciding on the funds, that should really form part of the allocation?
Well, I guess from a portfolio allocation point of view, the fact that the market's demonstrated fairly consistent alpha over the public markets suggests you can now really go boots and all out using portfolio theory. You can have confidence that you're now dealing with a market that's mature enough where you can start to apply all these portfolio theory and start to allocate to the market with confidence that it's going to produce the sort of risk-return profile that you need to justify an allocation. Because compared to public markets, the obvious difference is private markets are illiquid, public markets are liquid.
Right.
So to allocate to private markets, you need some confidence that you are going to get the sort of outperformance, the risk-return profile that you see in the States or Europe. And so, okay, we've now got the proof that's here. So you can start to allocate confidently. What that means in terms of any individual's allocation is going to be partly a function of the size of their portfolio and just their ability to take illiquidity. And what you see overseas is, where, at the extreme, some of the endowment funds for universities, Yale's the poster child for this, went well over 60% allocation. Now they can do that because very long horizons, not much need for liquidity.
Yes.
They just need the cash coming off to fund the university budget, which is sort of predictable. But for an individual, obviously, you can't go that far.
Yes.
So I think the typical range for individuals overseas is sort of 5% to 15%.
Sure.
And then the larger the pool of capital, the further you can go.
And so that's one part, which is around allocation, and possibly, in India, we may have we may not really see institutions going up to 60%, given the nature of the products, that we have. Like, for instance, the EPFO, it's a fund, which also needs an annual return to be paid out to the subscribers. So, possibly if at all, they get in, it may be a much smaller proportion. The other part of the question was, when, you are looking at selecting the funds, what are the important metrics, that you look at?
Oh, okay. So, the diligence is effectively in two parts.
Yeah.
I mean, many parts, but there's two main ones. And one is just the historical data. What's the historical performance been?
Right.
And that's where we use your benchmarks.
Yeah.
And we're looking for funds who historically have been consistently in the top two quartiles.
Right.
Because to achieve the numbers you need for portfolio allocation, you need that market average.
Yeah.
Well, you get that if you're consistently in the top two quartiles. So that's the first thing, just historically. But then beyond that, obviously, history is nice.
Yes.
But, what's the future?
That's right.
And so there's two sets of things that we can look at to form some sort of view on how likely a fund is to repeat its performance. And one is just factual. Have things happened which would negate the past track record? So has there been turnover in the team of key people who were responsible for some of the best deals?
Yeah.
Has the GP had style drift, strategy drift, for whatever reason? Was their strategy particularly tied to a certain set of market conditions which have now gone? And you might see that more in a sector-focused fund, or someone whose returns were very much driven by exiting quickly in a bubble which isn't there anymore, something like this.
Yeah.
So those are the factual questions. Then once you go beyond the factual questions, if it still looks like everything's on track, you then start a much more qualitative, touchy-feely analysis of what's their business model like, and do they have a competitive advantage? Because that's really over time what allows someone to keep on outperforming. And that goes in three parts. I mean, do they have any sort of competitive edge in sourcing transactions?
Yeah.
Do they have a competitive edge in adding value to companies? And often that feeds back into their sourcing, because if they're good at adding value, then entrepreneurs see that and they get better deal flow because people want to work with them.
Yes.
And then, do they have some skill in planning exits and getting out at the right time? And so we go back through their track record, and just to understand this bit, you need to spend a lot of time talking with them.
Yes.
And just understand that. And if you can identify where that competitive advantage might be, then you can be reasonably confident that they can repeat and stay in the top half. If, on the other hand, you sort of see that, maybe, well, for instance, as funds get more successful, they tend to raise more money and more money and more money.
Yeah.
And sometimes too much money.
Yeah.
And sometimes they move themselves outside. Say someone was in the early stage growth space, so sort of BC rounds, and they had fantastic deal sourcing there because they had the right connectivity, the right network, they had the right reputation. Then they triple their fund size.
Yeah.
They go up at that size. You're out of that space.
Yes.
Maybe they don't have such good deal sourcing there.
Yes.
Also, the way what's required to add value changes from sort of seed A stage through to BC through to private equity.
Yeah.
So the very early stage stuff, it's all about working with the founder and helping the founder adjust and change business models and this sort of thing.
Yes.
It's very founder-centric. So you need to be good at understanding that and working with founders. Out at the other end in private equity, it's got nothing to do with founders. I mean, the founder might be viewed as a problem because they've grown, the company's grown past the founder's capacity.
Yeah.
And so now it's much more about what's the business model, what's the dashboard of metrics you need to tweak and change to grow the company.
Right.
It's much more programmatic. And someone who's got that programmatic skill probably can't go and do seed stage. They'd be horrible at it because they're just not founder friendly. Someone who's got the seed stage skill, very founder friendly, they probably can't do the programmatic stuff.
Yes.
So basically it's just a way of saying people need to stay in their lane.
Yeah.
And if they go outside their lane, you've got to question whether they can be successful in the new lane they've gone to.
Right.
People talk broadly about the private markets or venture capital.
Yes.
They're different spaces.
Exactly. Yes.
They're really quite different spaces with different deal sourcing networks, different ways of adding value.
Right.
And you've just got to make sure that someone stayed in the niche that they've demonstrated they're good at.
Yes. The point that you spoke about, with the stewardship, supporting the corporate, the company in terms of, their way forward. So how do you assess stewardship? I mean, I don't know, if it is connected to, the flow, but, it's because that's a very difficult one. I mean, you may actually have a VC, who may be too demanding, right? And one, who may actually be very. I mean, it can be construed as being demanding. It can also be construed as being very supportive. Yeah.
So that the way, there's a couple of ways. One is, and they all involve talking to lots of people.
Yeah.
There's no actual data place you can go to.
Exactly.
So, but firstly, just when you talk to them, are they saying what you expect someone in this space to say? So if someone is dealing with seed stage people, are they talking all about helping founders? If it's a private equity guy, is he talking about more a dashboard and a programmatic?
Yeah.
So just, are they generally talking the way you'd expect someone in that space to talk? And if they're not, then you don't dismiss them, you dig deeper to find out why not. But you may get an interesting answer, but you also may find out that no, they're just not fitted for the space. Second thing is just get them to talk about examples and tell you how they see things. And then go and talk to the founders of the companies and see how they saw things. And you get a very clear read from the founders. And also it's interesting talking to the founders. And by the time someone's got to sort of A or B rounds, they've got multiple VCs in there. And it's always an interesting conversation with the founders. Well, how do they all behave? How does this one behave differently to this one? And you start to understand that the guy who was good at the early stage had these strengths and they're great at the time. Now we're onto this stage. We keep him on the board because we know he's smart. But really the value ad's now coming from these other people. And you can sort of get the pattern of who's doing what at what stage, but also who just happened to make a good investment without adding value. They sort of went for the ride. And with enough talking, you can figure that out. And to be honest, if someone's got a fantastic track record by just going for the ride, maybe they've just got the good connections and their deal sourcing is superior. I mean, so you can't write them off. It's just a question of understanding who's good at what. And as long as they've got a competitive edge somewhere. But where you get feedback, I mean, mostly we're talking to good GPs, so the feedback when you finally talk to the entrepreneurs is positive feedback. In fact, sometimes it's incredibly positive. But occasionally you strike one that's going, yeah, that guy. And you say, okay, the GP's got an inflated idea of what they did.
Understand. So effectively, the size of the exposure is not necessarily, a factor, that really matters. The point that you spoke about, someone who may have actually been a part of the ride, as long as, he's been consistent when it comes to deciding, which of the entities that he needs to be part of.
Well,
he's still doing a good job.
Well, also too, what you find with a lot of the early stage guys, they know where their limit is. They know they should be handing over. And so at the early stage, which is their core expertise, they're the guy who's adding, being the best help, who's being the sounding board that the founder needs. But they know that as the company evolves, it needs much more technical help, much more sort of detailed hands-on stuff. For example, a very small GP might be good at occasionally sourcing someone for the company. Finding good staff is part of the role. When a company gets larger, you probably need an in-house operation to find enough staff. And a small GP can't do that. Or an early stage GP, I should say an early stage GP. They know they need a later stage GP who's got that capacity. And so in a way, some of the early stage GPs know that, okay, you've got another round coming. Here's the GPs who are lining up to invest. This one's probably got the skill set. and they sort of hand off.
Yes. In the recent past, we've seen a lot of IPOs, coming out. In fact, the previous year we had a record, 210 IPOs, that got, that we saw. From the perspective of the AIFs and more so, the later stage funds and their ability to generate good DPIs as well as, exit, how do you see that? I mean, because there's a lot that's also getting spoken about, the markets being quite heated up. So, how do you see IPOs in the context of exits?
Okay. I got what I like to see is a full range of exit options. So, can you sell to another company, a trade buyer? Can you sell to another fund?
Yeah.
Can you do an IPO? I like to see all those things operate.
Yeah, all options.
And I think looking at it holistically, the exit options in the Indian market are really improving. I mean, the IPO windows are pretty obviously taken off.
Yes.
And so that's helping all the later stage funds. But then as they exit, they need to acquire. And the earlier stage funds tend not to exit through IPO, but through sale to later stage funds or sale to companies.
Yes.
So as the later stage funds exit, they want to acquire. That helps the earlier stage funds. So you get a nice cycle going.
Yes.
Likewise, the growth of larger funds, who are now focusing, funds who may not be totally India focused, the larger global funds or regional funds, paying more attention to India. That's why some of the sizes of deals have increased.
Yeah.
That's also important because then companies can continue scaling and find an exit.
Yeah.
They won't scale and suddenly find they've grown too big for a local exit. There's a foreign exit.
That's right.
So I think the whole exit ecosystem is just looking a lot healthier.
Yeah. We do see, in fact, in terms of the segmentation of the stage of deals, we actually see a lot more activity now in case of growth as well as late stage as compared to say 10 years back, when most of the deals were actually happening in the early stage.
Certainly the data shows that.
Yes.
And it's a sign that the market really is reaching maturity.
Yeah.
When you can start at pre-seed and go all the way through to growth and then private equity, and between growth and private equity, IPOs or sale to larger foreign companies.
Yeah.
It's getting to be very much a sort of a full ecosystem.
Yes.
I mean, one of the things historically that, this is going back to the 90s, that India had issues with, there's a little mini boom of VC activity in the 90s.
Yeah.
And that unfortunately went nowhere because the early stage companies couldn't get later stage funding.
Yes.
You didn't have the whole ecosystem in place.
Yeah. Right.
Well, that's just not true anymore. The whole thing's there.
That's right.
So the report that we've been doing, I guess from Oister's perspective, what stimulated us to come and talk to you and develop this was we saw the need for a clearer benchmark.
Yeah.
And on the one hand, I mean, the fact that SEBI has required benchmarks and required reporting is fantastic.
Yes.
But the benchmarks they required were based on Cat 1, Cat 2, Cat 3 AIFs.
Yeah.
And from an investor point of view, that's not quite focused enough. So, for example, Cat 2 AIF can actually include early stage stuff or late stage stuff. It can include funds that are up to 49% in public markets. So you sort of needed to separate this out to get a real indication of how the asset class itself was performing. And so this is where it's fantastic to meet CRISIL and just have the benefit of your ability to obtain the data, but also to separate it out and create benchmarks that are much closer to being, true VC or private equity benchmarks. And the fact you've now got enough data to separate out early stage and late stage is really useful. It really does give investors a much clearer idea of what the asset class is doing than the benchmarks based on Cat 1, Cat 2, Cat 3. I mean, how do you see this?
No, undoubtedly. So, in terms of the, for the benchmarks to really be representative, you're right. I mean, it needs to be created with the right set of peers. There are challenges in terms of the, in terms of the standardization of terminologies, that are used, like, what may be early stage for one fund may not necessarily be the same for the other. And therefore, we haven't really been able to get that moving in terms of the public benchmarks that we publish. So, working with Oister has been very helpful, because we have actually been able to segregate, basis objectives, that the funds have, and and we've therefore been able to put out a more granular set of benchmarks. One of the primary use cases is it gives the investor a good perspective on what could really have been the experience, for a specific subcategory of funds, if they were going to invest. Besides, of course, enabling them to compare, measure, how their performance in a specific category has been. I think, from the perspective of information and understanding on performance behavior of a specific subcategory, these certainly become very, very relevant. And I think in that context, the benchmarks are very, very useful, and we certainly would be keen to look at more granular cuts going forward, as the industry evolves.
And I got to admit, I've been impressed with the amount of time you take to clean the data up, because all these people report slightly differently.
That's right.
Would you like to give some flavor of what you have to go through to get this?
Yes. So in fact, we do speak with the funds. In fact, the conversations with the Oister team has also been very helpful. So, it is not very standard, if I were to put it. And therefore, there's a lot more understanding of the funds, that is needed, before you get into the granular segmentation.
But even the way the funds report to you, when the data isn't totally clean fund to fund.
Yeah. So we actually, we do come across some inconsistencies, in which case, we would reach back to the fund. There are times, when they may make some changes. So, it does happen at times.
Because I just think, again, going back to comparing the Indian situation with global markets, the fact that there's required reporting, and then there's professionals like CRISIL actually going through and checking and making sure it's all the same standard.
Exactly.
I mean, the quality of the benchmarking in India is going to be, I think, better than anywhere else.
Yeah. So we certainly don't just take whatever comes to us, and it's not like an operations exercise alone. There's a lot of analytics as well, that goes in to ensure that the data that is being ingested is correct.
The first report that we did got a very good response. But the one piece of criticism was, you got yes, it's nice. This is a benchmark that's better than what's available because it's truer to the asset class.
It's still broad,
but it's still broad.
Yes.
And as a portfolio manager, I've got small cap, I've got large cap. I need to compare to those. So this report, we went and separated, or you went and separated them out, and I'm very pleased you had the data and the patience to do that. I guess when we did that, in terms of what was surprising, it wasn't really surprising, it was a relief to see that both the small cap and the large cap had consistent alpha. And surprisingly, at the moment, they're reasonably similar to each other.
Yes.
I mean, I've got to think, I would think over time, the alpha for smaller, earlier stage and later stage will be sort of, depending on market conditions, they'll vary.
Yeah.
But, certainly the data we've got to date shows that they're both healthy and they're both consistent.
Yes. And of course, the fact that, year on year, you've seen positive returns. That's also quite an interesting statistic. Yeah.
I mean, I've got to think the other data point was just the growth in large deals.
Yeah.
And that really again shows, as the market scales, it's attracting more people and the large deals are happening.
Yes.
And likewise, just the growth and diversity of sectors.
Yes.
Going from, 10 years ago, 75% in consumer.
Yeah.
And now multiple sectors over 10. So that whole progression was just interesting to see.
Yes, you're right.
So what do you think is coming next? What's the next thing that you think will excite you in the development of this market?
I'm just thinking about the answer.
I'll wait till you thought.
Possibly, You know, a lot more of the domestic institutional allocation to alternates, because that's one part, you know, which is still, you know, which has still not really happened. Other than a few insurance companies, you know, which are investing, there is a lot of potential in terms of allocations, and possibly, you know, that's going to be another big trend, you know, whenever that happens.
Yeah, that's an interesting point. I hadn't thought of that, but this market's been very much individuals, family offices, and then foreigners.
Foreigners, exactly.
And once the domestic institutions step in, it is going to change things.
Yes.
Yeah. I guess from my perspective, the interesting thing is just seeing the growth of deep tech here.
Yeah.
You know, the fact that you've now got a functioning sector.
Yes.
With reasonable size, not huge, but reasonable size, but doing some really interesting things.
Yes.
You know, from rocketry to satellites to robotics to
Yes.
AI.
Yes.
It's really very interesting.
Yes.
And I got to admit, I think again it shows depth and maturity, because I hadn't expected to see that much outside the US or maybe Europe.
Yeah.
But it's there and it's real.
Yeah. Absolutely. I mean, you know, because generally, you know, we keep speaking about the demographic dividend, you know, the consumerism, you know, as being one of the enablers, and this is technically very discrete. I mean, it has nothing to do with that. So I agree.
Yeah, no, you've got all the guys doing sort of tech enhancement
Yes.
of existing industries.
Exactly.
And then off in this little sector over here, you've got some really new exciting stuff coming.
Yes. Yes.
I mean, personally, I'm looking forward to my first ride in a, what do you call it, a air taxi to overcome the traffic from downtown Bangalore to the airport.
You may probably need that in Bombay.
Oh, really?